Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. We've had one of the worst rate shocks in history. This is the 1-year yield, so a good proxy for what the Federal Reserve interest rate is, going from 0 to almost 4.5% in just a few months, right here. Massive move. Yes, the market is down. Yes, the market is in a bear market, but this hasn't been as painful as the 2008 financial crisis. It hasn't so far been as painful as the 1970 to 1974 period where the market came down 50% over the course of 5 years right here. And so a lot of people, a lot of investors have the opinion that the worst is yet to come, that the rate shock that we have today is actually going to lead to a collapse in earnings, a collapse in stocks, a collapse in the economy, a massive rise in the unemployment rate, and probably trigger something along the lines of what we saw in 2009. Now, before we dive into that, I want to make a quick announcement. It is our 2-year anniversary at Game of Trades. It's been 2 years since we launched the service at gameoftrades.net. It's been such a wild ride full of amazing experiences. And so we want to give back on this special day. We're doing a 20% discount on the service. I want to say it really has been a privilege to be able to help people navigate the market, to be able to help people educate themselves on the financial markets, and really try to give access to quality investment research to a maximum number of people around the world. I'm so grateful for the community and everything that you guys are enabling us to do. So in order to celebrate and say thank you to the community, we are doing a 20% discount on the membership. This is a limited offer just before the new website update. So use the discount code that's in the description below and check out our service. Now, coming back to the video, we have this rate shock that's been bringing down the market, and market sentiment has become incredibly bearish as a result of that. You can see right here, institutional traders, options premium here. Just a wild chart with the premium that large traders are paying for put options on the market. So betting that the market is going to go down. It's down to the same levels as the level we saw throughout the 2008 financial crisis. So this is a big deal. Lots and lots of bearish sentiment around this. Quite a unique situation. So is this rate shock actually worth all the fear? Now, we studied this in detail, and we posted an article on gameoftrades.net that highlights what happens to earnings after an interest rate shock. And we went into the details of this in this piece. And you can see here, this is one big rate shock. Again, this is the 12-month change in the 2-year yield. And look at this massive rise we've seen on the 2-year yield, something we haven't seen again since 1980. This type of rate shock is just absolutely massive. And as a matter of fact, the last time we saw this type of rate shock, right, and we used this threshold here, that dotted line, to classify a rate shock, and we have 14 episodes since 1963. The last time we had this was in 2005. And so a lot of people say, okay, the economy is not less fragile today than it was in 2007. So if this rate shock right here caused a collapse of the financial system, what is this going to do? Because this is a lot bigger and the market is a lot higher. And you'd be absolutely right. Although in that piece, we did highlight some of the key differences we have between now and 2008. It does seem like after a rate shock, on average, earnings go down after about 14 months, right? 16 months, earnings start to decline, and you really start to feel the effects of that rate shock. So that thought process is completely accurate. This is not benign. It is going to have an impact on the economy. It is going to have an impact on earnings, but a lot of people think that's going to be the case now. A lot of very smart people, in fact, say, okay, rates have risen a lot ever since around March here, where they really began the tightening cycle. Rates have risen, and so you're going to see earnings get hit in a big way as a result of that tightening. Now think about the number I just gave you. 14 months is around the time it takes for earnings after a rate shock to, first of all, roll over and then really come down. 14, 16. Some of our statistical work says it's even 17 months before you really start to see an impact of the rate shock on earnings. And so if we really start to see the effects of tightening 14 months after March of 2022, where you had the first rate hike, how long is it before you actually see earnings deteriorate? How long is that? Well, it's at least a year, 14 months, right? But more specifically, it'd be around May of 2023. Another 6-7 months before you even begin to see earnings get hit by the tightening that we've seen so far. That's the window of opportunity for us. That's the way we're looking at the market today, is we have inflation that's still high, right? And we have around 6-7 months before the earnings outlook really starts to get worse. If within those 6 to 7 months you see a big decline in inflation, if that happens, and we think that's going to happen, everyone has their own opinion. There's a lot of very smart people that think inflation is going to continue. We don't think so. We think inflation's coming down here, and we have a lot of reasons for that we talk about on gameoftrades.net. But if that happens, you could see a massive rally, right? A big rally as a consequence to the market getting optimistic that inflation coming down somewhat to back to reasonable levels. It gives the Fed room to stop tightening, and earnings don't collapse. You could actually see something along the lines of what we saw in 1982 right there, where yes, the bear market took a long time right there. It took many months, lots of pain for investors, right? Especially if you bought right there. That was a pretty violent bear market, especially considering inflation was hot there. But look at this rally. Boom. In just a couple of months, you see that entire bear market retraced in a very powerful manner. It's not out of the question that we see this type of market reaction when inflation breaks down. Now, of course, we're going to be walking you through these developments step by step on gameoftrades.net. We have a dynamic model portfolio that we update multiple times a quarter. We have buy and sell ratings on the key assets that we're looking at with price targets that reflect our models and the way we're looking at the macro, all to make sure that you have access to high quality research that's communicated effectively through the model portfolio, through videos, articles, summaries that really take in all that information, complex outlook on the market and makes it actionable, simplified, and into a service that anybody can actually use, whether you're starting out investing or you already have quite a bit of experience and you even want to deepen your knowledge, educate yourself on the market. That really is our goal. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button as hard as you can and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.